The markets are trying to make you fail. And on that bombshell, let's get straight into the show. Welcome to the Traders Clinic, your regular shot in the arm of trader insights, philosophy and knowledge, brought to you by two money managers, Ali Crooks and Charlie Burton.
Each show, we answer your burning trading questions and we cover all things from the world of trading. So on that bombshell, we're going to start with the statement of the markets are trying to make you fail.
I think this is what everybody should have that in their mind, that the market is predisposed, it is geared to try and make you fail. If you think of the market like the devil, and that he's constantly sitting there on your shoulder, talking in your ear, saying, do this, do that, go on, look at this market over here, go on, get in. If you think of it in that way, then it's probably a good thing, because the market is constantly trying to make you make mistakes. Let me give you an example. So I was talking to a trader recently who had been in a trade this year and been in it for quite some time, had a really good run. Then the market had pulled all the way back over in a deep retracement. He hadn't been stopped out because although it was a deep retracement, he'd been in a big profit. But you imagine you've been riding this profit for a month or so, maybe a bit longer. Then you've gone through a month of drawdown off the highs.
Yeah.
He's still not stopped because his entry's down here. And everything's fine. Then it starts going up again, so that's good. And then it stalled out over here and then started pulling back over. It hadn't made a new high when it had come back up, but it was, so still from where he's got in, it's okay. But he's now 3 months or whatever it is down the line. And when it stalled out and started rolling a little bit here, he said, the market got him, and he just said, and I just jumped out. He said, because I thought at that point, I thought, oh, that's it now. It's going to roll over. I might as well bank my profits. So he did still have a profit, and then all of a sudden that market then turned around literally about 2 days after he exited, and it went and it had a flyer. And it just goes to show you how the market can grind you down. You can have the best of intentions and say, well, I'm holding on for this level over here. And then in a moment of weakness, he second guessed what the market was doing. And what's happened? That little devil is on his shoulder saying, you might as well come out now. It's going to go down, isn't it? So we might as well bank our profits. And that's a classic example of how even when you've got the best of intentions as a trader, and it doesn't matter what system, and you've got targets and stuff, and he's got his targets and whatever, how it can grind you down. And people might say, "Well, I'm not going to swing trade then. I'm not going to hold on for trades that long." Doesn't matter. It'll get you in other ways if you're doing shorter term trading as well, and we'll talk about that. But that's just one example of how the market can get you, even when you've got the best of intentions, your analysis is correct, and the market still jumps you out. And I often use the analogy of the market is like a bucking bronco. It's trying to shake you off all of the time.
It's fascinating you said about short term, because I saw that example play out. I remember working with a trader once, and almost the exact same chart pattern on a 5 minute.
Oh, really?
Came up, then hovered round, and what was probably an hour and a half, 2 hours of it doing that.
Wearing it down.
Had the best of intentions, was following his strategy, was doing everything right, and just time was enough based on his perception of what was going on, his perception of how long he should be in the trade. That hour and a half was enough for the best of intentions to disappear.
Yeah.
And I think thinking about the idea of this idea of the devil or the market trying to make you fail, I think a lot of it is because a lot of traders don't have a feedback loop. So they are sat there and they're looking at the chart. The chart's not talking to them. The chart's not doing anything. It's what's going on in their own head. So if they've already got an idea of how long a trade should be, or unconsciously they don't understand how quickly their rule-breaking responses come in, then these things are going to happen because nobody's sitting there putting a hand, just stopping. No, just stick to your rules. It's the argument. It's the Jekyll and Hyde, the devil that's going on in their head all the time. And I think this is why you can have the difference between an analyst and a trader. Well, you've got tons of analysts out there that can tell you what they think's going to happen, and then when it does or it doesn't, they can stick their hand up and say, "Yes, I was right." And that's very different than being in that trade for 3 weeks or 3 months or even 3 hours. And I think it's so important that people realize that they're playing a game with themselves.
Yes.
as well as this thing that is the market out
Yeah,
there.
and when you just said that, it just provoked something in me when you said about this feedback loop. And this is why I say to traders that you must use self-talk a lot. Because people think, oh, I'll just have a strategy and then everything's all right. No, it's not. You can have the best strategy in the world and you'll still lose money if you haven't got your mindset there. And so one of the aspects of mindset is self-talk and repeating your analysis to yourself and repeating and reminding yourself why you're in this trade, what the intention is, why you're still holding for that given target, and reminding yourself that, okay, I could jump out now and bank this profit right now, but what if I'm wrong? And what if it doesn't carry on going down right now and it does turn back up? Will I kick myself? Start delivering these statements to yourself. If I do this, will I kick myself? If I do this and it goes back up, how much is that going to impact my longer term profitability? Because all of a sudden you've taken a small profit or maybe a break even or whatever it might be, as opposed to a much bigger that could have been your trade of the year, for example. Or as a day trader, it could have been your trade of the month. And you've now just missed out on that trade a month because of 1.5 hours has ground you down. So in that 1.5 hours, like this other trader over that last, whatever it was, 2 months, this is why you have to keep doing the mindset, talking to yourself and going through all the different scenarios of what the market is possibly trying to get you to do. The market is an organic thing, as I say. It's a living, breathing entity.
Yep.
And so it's not that it's talking to you directly, it's just doing its thing. But by it doing its thing, you are tapped into that matrix. And unfortunately, it will affect all of us. I mean, it's trying to probe you, I'm sure, as well, and it's trying to probe me all the time as well. We're just that little bit better at dealing with it than some others.
And that idea of it probing you can generate an idea where the time's the issue, or suddenly that trader then goes and looks at a piece of information, news source, sentiment, or something they don't normally use to try and back up what they're thinking or feeling. And I think what's interesting when you talked about self-talk is even the language you use was very much moving your mind back into the long term, whatever long term is relative to the trade. Because when you're in that when you're making those decisions that essentially weren't part of the plan, you're actually often not necessarily present, but you're in the moment because you're not liking what you're feeling and you want to get out of the trade, or you don't like the idea of what's happening. But interestingly, your self-talk was very much about, okay, what if this was going to be the trade of the year? Well, just by doing that, your time horizon has gone back out to a longer period of time, which so many traders struggle with.
The consequences of your actions today, right now, could have lasting impacts on your trading. Possibly, there's a difference between. It comes down to even hesitating and not taking that next trade after you've just had a couple of losing trades. The consequence of you not taking that next trade, which let's say goes and becomes a 3R or whatever it might be, depending on the person who's trading, well, you've just missed out on a 3R trade. Well, that could be quite important to you.
Yes.
and important to your overall results. So these are longer lasting things, and this is why self-talk is so important, to remind ourselves, look, I can't afford to not take this trade. I can't afford to bank this profit right now. I can't afford to bank that profit. Yeah, I know, but I'm in a nice profit. I want it. Yeah, I know, but if that's not the plan, if that's not the target, if that's not your strategy's target or your approach's target, you can't afford to bank it. You've got to allow it to work its way out as much as possible. It's not easy. You're always going to move your stops up, and of course there's going to be those times when you're just going to get trading stopped out. But let's not add another layer to that and start jumping out for other things.
Great. Good stuff. Which leads on to this. This is a question that's come in about data. Should currency traders be acting on inflation data? And obviously at the time of filming this, inflation is the hot topic, has been for what feels like a year and a half. And I think the underlying thing with this is, what do you mean by acting? So does that mean that you're now going to pay attention to inflation data because you weren't before? Are you in a position where you're not making money and you're looking for a reason to bring something in to try and improve your trading? Because the challenge is it's inflation at the moment, but as you were saying earlier, it's something else a year ago. It's something else the year before. And I think that's an important thing for people to realise.
I think, there's maybe a couple of things. We don't know enough information. That person might be thinking, should I be day trading CPI inflation data releases? You don't know because there's more volatility on that event now. It's one of the high volatility events, whereas a couple of years ago it would have been something else. Non-farm payrolls for a long time actually was in the doldrums, although it's always been a marquee event. Really, up until this last year, non-farm payrolls was a bit of a non-event. You get a bit of a squiggle and not really too much. Now it's all about jobs and inflation. And what I think is interesting is that people think that they've got to tap into that macro. And don't get me wrong, I like the macro, and I do enjoy knowing as much as I can about what's going on. But you've got to have a filter. So you've got to be able to learn how to filter some of that information out. Otherwise, you'll be very careful that you could say, well, inflation's come out higher, so therefore whatever the currency should appreciate on the back of that. But if you take the US, for example, from October, let's say, of last year, in theory, if on a macro basis, inflation was running red hot, and yet the dollar has been depreciating since October of last year. So you do have to take a bit of a holistic approach. Any singular piece of data, sometimes the markets might actually be moving in the opposite direction. It's not a guarantee that just because a macro story is there, the markets might be doing something else.
And I think it's also very easy to post-trade use something like that and say, oh, this piece of news, not necessarily inflation, but anything, you can draw a conclusion with the benefit of hindsight and say, oh, that trade didn't go my way because that news announcement came out and it was this or it was that. And I think that's a very dangerous place to be, because that's another example of not being able to filter the information that's coming in. You're now trying to justify the trade or justify the losing trade. And I think it's very important that you don't jump on something just because it is the news and it's the fad.
Yeah, if you've got a strategy or an approach, well, do you need that information? Is going to move the markets around, but should you be adjusting your strategy and your approach just because, oh my God, it's inflation day today, I better jump out of my trade? Well, hold on a second. If you look at those charts historically, would you have jumped out of all those?
Yeah, I say this all the time.
Yeah, you wouldn't do. So, and coming back to the whole filter thing, we talked over a coffee earlier on, and I mentioned Jesse Livermore, one of the world's historically greatest traders. In the late 1920s, he was worth $100 million. I mean, a huge amount, colossal. And yet, in the end, he moved away from what worked for him because he started to allow the filters to allow external information to come in, started taking advice from external advisors and stuff, and ended up losing a load based on all the other peripheral advice he was getting, which he didn't actually need. So sometimes you've got to look at, okay, yes, there are key events that take place during the month. If you're an intraday trader, yes, you might well be looking at those as key trading events, but otherwise, just don't let them get in too much in the way of what your overall approach is.
Great advice. So, lastly, interesting question is, sometimes I enjoy trading. A lot of the times I don't. How can I enjoy it more like you guys seem to? Well, I would say I don't enjoy it every single minute of the day, but that's kind of why I enjoy it, because it's the challenge. So, again, this is a little bit of a loaded question, and there's not enough information. But I would make an assumption that this person is enjoying their trading when we discussed this before, when they're winning. So is it a case of, well, you're only enjoying your trading when you're making money, and only you're not enjoying your trading when you're losing money? Well, that's the first issue that it brings up, is if you are too results focused rather than process focused, that's going to be an issue. If you're constantly basing your mood on whether or not you're up or down, then it's going to be a very long and horrible journey for you, because you're going to be down a lot of the time. So I think that's the first thing, is examine your thoughts and examine the association you have with what you're doing within trading. So basically, are you too linked in and too emotionally dialed into whether you make money? It doesn't often have to be each trade. I can see this with traders at the end of the month. So they've unknowingly said, right, oh, I'm down this month, but 2 days into the next month, they've had 3 winning trades. So they're making their decision on how they feel about trading based on an arbitrary point in a line in the sand, i.e. the end of the month. Yes, you've got to measure over time how you're doing, but to allow your happiness to be defined by whether you're making money that day or that month, I think is a recipe for disaster. And we were discussing, I think this is something that people find interesting, is a lot of people get into trading. They may not have got into trading for the love of it, but I think there's a really interesting point there that you brought up.
Most people get into trading because they want to make money. And so they don't get into trading because they think, oh, I'm going to love this. They get into it because it's a means to an end. It's a way of making money. But once you get into it, and so once you get into it, you and I said this over a coffee earlier on, we would have been exactly the same as that trader when we would have started, that you only enjoy it when you're winning, so to speak, and you won't enjoy it when you're having losing trades. But you need to transcend that. You need to embrace all aspects of trading. So, and accept that, let's say 50% of the time, you're going to be having losing trades or whatever the percentage is. So embrace that as well. But what people do is they focus on the percentage of the time that that they are right, and they don't want to think about the times when they're having that relatively large percentage of the time that they're going to be wrong. Even if they've got a 60% win rate, it still means you're wrong, or say wrong, I'm using the wrong language there, but you're having losing trades 40% of the time. In life, most of the time, we're not used to that.
No, exactly.
So you have to learn to embrace all of it and learn to enjoy all aspects of it. There are still going to be times when the market's going to wear you down a little bit if you're going into a drawdown, and a drawdown is maybe an extended drawdown, which at times will happen. It's statistically going to happen. If you're trading for long enough, you are within a 10-year period, there are going to be the normal drawdown sort of periods, and then are going to be those periods which are extended drawdowns that we're outside of the shorter drawdowns. So we have to embrace all aspects of it and keep reminding ourselves that this is just one step, another step in my journey as a trader, and I have to learn to enjoy it. So I'll pose it to you. How can you turn that negative of losing trades into a positive? How can a trader learn to enjoy that?
So lots of ways. I think one of them is have an understanding of what you're trading. So and your approach to it. I see this over and over again. Somebody will put in 2 or 3 months worth of testing. So they'll test a strategy. But what they'll do is they'll filter that information and see, oh, wow, that strategy is making 100% over a period of a year, and they're focused again. Even though they've done all this extra work, they're back to focusing on the result. And they're like, what they've not done is taken a look at the data and go, well, what's the price I'm going to pay for this supposed 100%? And then they maybe do that, and they go, oh, okay, well, I'm going to have 3 drawdowns over 3 big drawdowns over the year. I'm going to have 3 periods where I'm losing money. But then they go into the year of live trading expecting the upcoming year to be the same. So then if they have 4 periods of drawdown, they suddenly think something is wrong. So again, it's this expectation. I think people will go in and they're quite linear. They go, oh, okay, well, it's made this for the last 3 years, so I'm going to expect it to do the same thing. So I think the big one would be to lower your expectations, but is it lower or widen your expectations, or expect the unexpected?
Yeah.
Go, okay, if I go into next year and the strategy has a bigger losing period, I need to be prepared for that. Because I can't assume that because it hasn't happened for the last 3, it's not going to happen in the year coming up. And again, I think if a trader is more prepared for the negative before it happens, and this isn't sitting there being negative, this is just taking time to think of the negative consequence. If that then happens, they're less shocked by it. And if they're not reliant on the result and they're less shocked by what happened over the last month or week, then they're better prepared to do it. And I think I use the metaphor of treat trading like a dance rather than a fight. If you're fighting, you feel like you're constantly fighting the market, then you're essentially going to wear yourself down. It's going to be much more energy depleting. Whereas I look at it as a dance. Sometimes you're leading, sometimes you're not. Sometimes you might stumble, sometimes you might do this.
We now know what he does a lot in his private time, don't we? Yeah, anyway.
Like a boogie. No, there you go. I used the word boogie with my daughter last week. She looked at me like, what? What? Boogie? What's wrong with you? And I realised how old I am. But anyway, so I think it's how you frame it. A lot of it is how you frame it. And don't rely on one thing. Don't do 5 years back testing and expect the trades to be the same. I remember working with a lady once. She'd done all this work. She was very intelligent, but she was so rigid in what she thought was going to happen as a result of what she tested. And her expectations were not met. So she went into it, and again, she found it very demoralizing and didn't enjoy it because she was too rigid in her approach.
I think we definitely have to expect. I think it's great what you've just said there. And just to add just one extra thing to that is coming back to what the market's trying to get you to do. Just remember, if you allow the market, if you allow yourself to feel a bit down and not enjoy all the aspects, the market's winning at that point. Now, I like talk about it that way. The market's getting to you. Remember, the market's always trying to probe and get to you. And so if you allow that and you allow yourself to get down, then the market's going to have you because you're more likely going to become a statistic and quit. So don't allow that. Laugh in the face of those sorts of things. Enjoy laugh at the fact, oh God, I've just had another losing trade. As long as you've not done anything wrong, and it's just, it's a logical trade, then you have to brush it off and move on to the next one. This is the market just testing me right now. I've got to enjoy all aspects. As Muhammad Ali said, he hated the training aspect, but he learned to have to enjoy all aspects of the training and all the exercise and nutrition and stuff, because it couldn't all be about when he was in the ring for that 12 round bout. He had to learn to love all aspects in order to, rather than only enjoying the fight itself.
Love that. So on that note,
his name's Ali Crooks.
His name's Charlie Burton.
And we'll see you soon. Trade safely out there.